Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Netflix.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Right. And, for years, the story with Netflix was just so simple, wasn't it?
So simple. It was all about one number, subscribers. How many did they add?
Exactly. But it feels like that chapter's really closing now.
It is. We're looking at a company that's, it's in a profound transformation. The pivot from just chasing subscribers to becoming this high-margin, cash-generating machine it's a whole new story.
Okay, so let's start with the fundamentals then, because the top line, the revenue, still looks really solid.
It does. I mean, you look at Q3 2025, revenue came in at, $11.51 billion. That's up 17.2% year over year. So the momentum is definitely there.
But, and there is a but.
Yeah.
We have to talk about the earnings miss.
We do. The Q3 EPS, the earnings per share, was $5.87. And that missed what Wall Street was expecting.
So if you just saw that headline, you might think, oh, the growth is stalling out.
You would, but that's not the real story here. I mean, the operational data is telling a completely different tale. The real breakthrough is their operational leverage.
Okay, what do you mean by that?
Their operating margins hit 31.3% in that same quarter.
Wow.
Yeah. I mean, to put that in perspective, that is a huge leap from where they were just a few years ago. It shows the company is finally cashing in on its massive scale.
So that margin number is what matters, not the slight EPS miss for one quarter.
Exactly. The street seems to be looking right past it. They see it as just noise, maybe some timing on content costs or something.
Because they're looking ahead at the projections.
Right. The consensus forecast is for huge EPS growth. We're talking 30.9% growth for 2025 and another 27.2% for 2026. That confidence is coming from one place: the belief that those 30+% margins are sustainable.
And that efficiency, that margin, it leads us right to the biggest change in their whole strategy, doesn't it?
It really does. It's the capital strategy. For, 2 decades, Netflix was all about burning cash.
Burn to build that content library.
That model is officially history. The company has moved from being a cash-burning machine to, what we call a structurally free cash flow generative business.
Which is, for anyone listening, that's the cash left over after everything is paid for, right? Including all that content spending.
Precisely. It's arguably the cleanest measure of a company's financial health. And they're projecting for the full year 2025 something like $8 billion in free cash flow.
$8 billion. That's a staggering number.
It is. And it's money they can deploy without going to the markets. They can self-fund everything.
So what are they doing with all that cash?
2 main things. First, they're fueling their share buyback program. That's the main way they're returning capital to shareholders now. And second, it lets them keep spending on content, but in a much more disciplined way. Still a huge number, around $18 billion for 2025. But now it's smarter spending, using all our data.
Right, so that's the foundation. Let's talk about the engines that are actually driving this. Let's start with ads.
Advertising is the big one. And it's scaling so much faster than I think anyone really expected.
This isn't just a small experiment anymore.
Not at all. The ad-supported tier now has about 190 million monthly active viewers.
190 million. That's on par with traditional TV networks.
It is. It gives them serious clout with advertisers. And financially, management expects ad revenue to roughly double in 2025 compared to 2024.
Double. So that's a whole new growth layer kicking in.
A huge one. And it's all about driving up the average revenue per user, the ARPU. Someone on the ad plan might pay less for their subscription.
But the ad revenue they generate actually makes them more valuable in the long run.
Exactly. Plus, they're building their own ad tech now, which is a big move. It increases their moat and lets them command higher ad prices because their data is so good.
So it's not just about streaming movies anymore. We're seeing this aggressive push into other areas to keep you locked in their world.
Right, to raise the switching costs. They're pushing into gaming, which keeps people in the ecosystem. They're even doing physical things like Netflix House. And then there are the new content formats.
Let's talk about that iHeartMedia deal, because that seems really smart.
Oh, it's brilliant. They're bringing over 15 top video podcasts. Huge shows like My Favorite Murder,
which has a massive dedicated audience.
A huge one. And this starts in early 2026. Podcasts are cheaper to produce, they bring a built-in audience, and crucially, they fill up the daytime viewing hours, which are typically harder for streaming services to monetize.
It's all about capturing more of your attention span throughout the day.
But the biggest catalyst, the one that could change the whole competitive landscape, is live content.
Live sports. The rumors just won't go away.
The chatter about a $5 billion investment is persistent. We're talking about things like WWE Raw or a much bigger NFL presence.
Why is live sports so critical for them, though? Their library is already gigantic.
It's about two things: audience captivity and ad revenue. Live sports are appointment viewing. It's the one thing you really have to watch live.
Right.
That guarantees a huge, reliable audience for advertisers, which means premium ad rates, and it just makes it that much harder for a subscriber to ever consider canceling.
Okay, let's switch gears to the stock itself. They did a 10-for-1 stock split recently.
They did, back on November 17th. And it's important to remember, a split doesn't change the company's value at all. The pie is the same size, just cut into more slices.
But it's a signal.
It's a signal. It's a move to make the share price lower, which can attract more retail investors, and it generally signals management's confidence in long-term growth.
And what about the technical picture, the chart?
Post-split, with the price around $104.47, the uptrend is very much intact. You have the 50-day moving average trending strongly above the 200-day.
That's a bullish signal, right?
It is. Traders see it as confirmation that the short-term momentum is accelerating faster than the long-term trend. It shows that Wall Street's confidence in those margins is translating directly into the stock price.
And the analyst price targets seem to back that up.
They do. The average target is around $134.13, which suggests there's still significant potential upside from here.
So looking ahead, say, the next 3 months, what are the key catalysts we should be watching for?
Well, the most immediate one is the Q4 content slate. The holiday season is always huge for them. Big series finales, maybe some of that new sports programming. A strong content quarter usually sets them up for a good earnings report.
And that report is coming when?
Late January or early February 2026. The guidance they've given suggests around $12 billion in revenue and EPS of about $5.45.
But the big institutions won't even wait that long, will they?
No, they'll be laser focused on the preliminary holiday subscriber update. That usually comes out around January 5th. It's the first real look at how the holiday push went, especially for the ad tier.
Okay, this all sounds pretty positive. We have to balance it out. What are the risks here? What could go wrong?
Well, competition hasn't gone anywhere. It's still fierce. You have Disney Plus and Amazon Prime Video spending heavily, which always puts pressure on things.
And content risk is always there.
Always. You spend a fortune on a big new show, and if it's a dud, that can trigger a sell-off pretty quickly.
There's also, I think, a growing operational risk. They're juggling so many things now.
That's a great point. Core streaming, ads, gaming, live sports. Managing all of that at once is incredibly complex. Execution becomes much harder.
And we should probably mention the M&A speculation, the Warner Bros. Rumor.
We should. It's highly speculative, but the talk of an $82.7 billion acquisition is out there. A deal that big would come with enormous integration and regulatory risk. It would be a huge question mark.
So what's the counter-argument? What protects them from these risks?
It comes back to the margins. That 31.3% operating margin gives them a massive buffer. It allows them to absorb shocks. Plus, their scale and their data are just. They're a huge competitive advantage that nobody else really has.
They know what people want to watch before they even make it.
Pretty much. And they've proven they can pivot successfully. They cracked down on password sharing. They scaled up ads. They have the management team to handle this complexity. Okay,
so let's tie this all together. What's the final thesis for Netflix now?
The thesis is that Netflix is no longer just a high-growth subscription service. It's a high-margin, cash-rich global entertainment platform. And the new growth engines, ads, international, live content, they're really just starting to kick in. This supports a long-term compounding story that's now all about profitability.
A powerful transformation story. So here's a final thought for everyone listening. If the ad tier is scaling this fast, and they really do drop $5 billion on live sports, how much higher could those operating margins actually go? Are we looking at a future where they could push towards, say, 35%, maybe even 40% in the years ahead?
Don't forget to hit that subscribe button for more in-depth analysis every day.